Hey everyone, happy Thursday. It is April 13th, about 11 o'clock on the West Coast. And so far this year, spring has been off to a slow start. It's been a mixed bag in the weather of the last week with more of that to come. But looking ahead in the forecast, it looks like we got a lot more sunny days on the way. And that's a pretty good metaphor on how mortgage rates went this week. It was a mixed bag in the data that we wanted to look at. But taking a look at things in the future, it looks like we're head for sunnier skies. So let's get right into it. Going back to last Friday, we got the big March BLS Jobs report. And there's three pieces of data we're really looking closely at in these reports because we know the Fed is looking closely at it. The first thing would be the job creations, and then that number was estimated at 240,000, and it came in at 236,000. So that is a check mark in the positive category for us. The next thing was wage inflation. Wage inflation showed it's slowing down, so that's good. So the Fed. It doesn't sound like it's good, but it's good because the Fed, when they see people making more money, they think they're going to spend more money, which is bad for inflation. So that is another check mark where we got 2 out of 3 so far. The third one, however, was the unemployment rate. So we wanted that to either stay where it was or maybe even tick up, and that actually dropped from 3.6% to 3.5%. So still at really, really low levels, and that is something the markets did not react well to, and affected mortgage rates. That news came out on Friday, which was Good Friday, and the stock markets closed. There was only limited trading for mortgage bonds and things like that. So it was really a weird day, and the data kind of reflected that. But like I said, a mixed bag. So 2 of the 3 things, looking towards the future, it looks good. But we really want to keep an eye on this job stuff because we know the Fed is as well. So the next thing we got yesterday was the March Consumer Price Index Inflation Report, which again is a very big one. This one we were actually worried about. We were worried it was going to come in a little weaker than stronger than we liked inflation numbers, but it actually inflation came in down lower than expected. So month over month, it was expected to go up 0.2% and only went up 0.1. Year over year, it dropped from 6% to 5%, which was great to see. The core came in as expected, just a gain of 0.4. And year over year, that dropped as well. And really what we saw was shelter is still increasing, or not increasing, but it's still having a big effect on this. So it was up 0.6% month over month. Year over year, it started to drop a little, 8.2 to 8.1. And if we look, shelter is basically cresting. So we've seen a couple different charts that look like this, but the shelter in the CPI has been going up and up and up, and now we kind of see it hit its high point and now start to come down. And we know that this is a lagging indicator; it's about 15 months behind, and every other data you look at shows that shelter inflation has been coming down for quite a while. So now we can hope that we're on this downward trend, and going forward in these consumer price index and the other inflation reports, we can see that start to reflect that shelter costs have in fact been coming down and not going up. Next thing we got today was the March producer price index. So inflation on the wholesale side of things, and that came in really good. It was expected to be flat, and it came in at 0.5% for the month. And then year over year, it was down to 2.7%, where last year at this time it was at 11.7%. So down 9% year over year, or since last year, which is great to see. And this is tended to be a leading indicator, which means that this comes before the March or the CPI numbers, because these are the people producing the goods that we buy as consumers in these other reports. So this tends to come ahead. So if we see this coming down, we should expect and hope that the other inflation reports will follow suit in the months to come. Next thing, we got the Fed minutes this week, and then there's a bunch of Fed speakers like every week. So the Fed minutes are going back to their last meeting. We get basically the minutes from the meeting, what they talked about. And what we saw was a mixed bag, just like everything else. Some of them were on board for not hiking at all. Some of them, if they said if there wasn't the bank stuff, they would have gone up a half a point. And, remember they went up a quarter of a point. Some of them they talked about a recession. They basically said that they think a mild recession is coming this year, and then there'll be a 2-year recovery. That's the first time we've heard them actually use the word recession, but you've heard me use it in the past. And then, like I said, the speakers are going, a lot of them, they're still drumming the beat of war for inflation, still talking about inflation's too high, they need to kill it. So it's basically the narrative driven, what's going to happen, at their next meeting. So we'll get that in a second. The next thing we got today was initial job claims. Those came in at up. It was expected to be 232,000. They came in at 239,000. So 239,000 new unemployment claims. And the 4-week average is now to 240,000, which I believe is the highest it's been since, not counting COVID, since 2019. So again, not something we want as a country to see unemployment go up and more claims, but we know the Fed is looking very closely at how tight the labor market is. And so the more claims we see, the more likely maybe they'll back off and not continue to hike rates. The next thing we got purchase apps. So purchase apps were up 7.8% last week, which fell in line with rates coming down. We talked about that before. Negative 31% year over year. So those numbers should start to look better as we go along because we're replacing worse numbers in the year last year. And then one just anecdotal piece of evidence with the mortgage industry. I did see that last year a report came out that mortgage origination companies and subsidiary banks, their average was a loss of about $300 per loan. So the mortgage industry did not have a good 2022. Next thing we got the average 30-year conventional. So last week we were at 6.18. We were down on a really low level. That BLS Jobs report kicked us all the way back up to, I think we got up to about 6.55, and now we're about 6.42. This survey actually hasn't come out yet today, so we might be a little lower than this. But again, keep that in mind. That's the average. Always talk to your lender, and each application is going to be a little different. So important dates coming up. We got the PCE inflation data is coming up on April 28th. So that's always important. That's the Fed's favorite form of inflation. Then we got the Fed meeting on May 3rd when they decide when their next hike what they'll do. And taking a look right now, the markets are getting at about 65% chance that they're going to hike at 25, quarter of a point, and 34% chance that they're not going to hike at all. So we much prefer this zero hike. This seems to me the prudent course of action to kind of see what happens given all that's going on. But right now the markets, based on everything the Fed keeps saying and different data, they're chancing at about 65% chance of what they're going to do. And then we got the next BLS jobs report is coming out May 5th. So that's one to take a look at. But really, I don't have it on here, but the date to circle coming up is May 10th. And I'll show you that. I've shown you guys this before. May 10th is when we're going to be getting the CPI for April. And we can see that, when these year-over-year numbers, we're always replacing last year's number, the way this data works. So we know that those are both elevated for that one. And going forward, there's some elevated numbers. So that's really, it's not when we're going to hit our target rate. That's not when rates are going to be, they're back down to mid-fives. But really, from that point on, May 10th, once we get that data, that's when we see things getting progressively better. So that's something to keep in mind. Keep your eye on the ball. Keep your eye on inflation and job numbers. One other thing to keep in mind, for your clients, inventory is still really low right now, which is leading to the spike in multiple offers again. This is, again, a really good appraiser out of Sacramento named Ryan Lundquist and SacramentoAppraisalBlog.com. And, as he shows here, the multiple offers in the Sacramento region are starting to spike again. And we're seeing that in Central Oregon. I'm sure you guys are seeing in other parts of California and other parts of Oregon. So that's something to keep in mind, that inventory is still really, really low. So, if you keep waiting for rates to come down, that's when we're going to see this spike even higher back to this 74% era, maybe even higher with how low inventory is. And then it's a very competitive market, and it's not as easy to buy a house, where right now you might have some advantages given where rates are. So that's all I got for you guys this week. A lot of data, like I said, we got to keep an eye on it, but sunnier skies are ahead. So if you need anything at all, please don't hesitate to reach out. I'd be more than happy to help. Have a great day, everybody.